Hey everyone, welcome back to Corporate Decoder. Today, Antero Midstream Corporation, or AMJust, filed their quarterly report for June 2026, and I am seeing some interesting moves that tell a story about their strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. They recently made a big acquisition and are selling off some assets, and the financial impact is starting to show up clearly in these numbers. Let's dive right into the financial picture presented in this report. We are looking at their balance sheet as of the 31st of December 2025, and then more recently as of the 30th of June 2026. One of the biggest changes is in their property and equipment net. It went from about $3.45 billion at the end of 2025 to over $3.94 billion by mid-26. This jump is a direct result of a major acquisition they completed, which we will talk more about. Also, look at customer relationships. This intangible asset more than doubled, going from about $1.07 billion to over $1.65 billion. This is a huge indicator of the value they see in the customer base they acquired. Overall, their total assets have grown substantially, reaching over $6.36 billion by the 30th of June 2026, up from about $5.88 billion at the end of 2025. This growth is largely driven by that big acquisition. Speaking of acquisitions, a key event for Antero Midstream was the HG acquisition. This deal, which closed in February 2026, brought in gathering pipelines and water handling assets in West Virginia. The report mentions that they are still finalizing the exact accounting for this deal, but the initial impact on their assets is clear. This acquisition was financed through new debt, specifically the 2034 notes, and drawing on their credit facility. On the flip side, they also completed the Utica Shale divestiture around the same time, selling off midstream assets in Ohio for about $400 million. This sale was meant to help pay down debt. The report details that the sale price was actually less than the value of the assets, leading to a loss recorded in 2025. But in 2026, they recognized a gain as the deal closed. Now, let's look at their long-term debt. As of the 30th of June 2026, their total long-term debt stands at over $3.56 billion, up from about $3.22 billion at the end of 2025. This increase is due to new debt issuances, like the 5.75% senior notes due 2033 and 2034. Interestingly, the report also states that on the 24th of July 2026, shortly after this report's period, they called for redemption of all their $650 million worth of 5.75% senior notes due 2028. This is a significant move to manage their debt structure. Turning to their income statement for the 3 months ended the 30th of June, we see their total revenues for 2026 reached over $327 million, an increase from around $305 million in the same period of 2025. Most of this revenue comes from Antero Resources. For the 3 months ending June 2026, gathering and compression revenue from Antero Resources was about $271 million, up from $248 million in 2025. This growth is attributed to higher volumes from the new assets acquired in the HG deal and new wells coming online. Water handling revenue from Antero Resources also saw a slight increase, going from about $73 million to $78 million. However, the report notes that freshwater delivery volumes actually decreased, but this was offset by higher rates and increased other water handling services. Now, let's talk about expenses. Direct operating expenses jumped significantly by 34% from $63 million in 2025 to $85 million in 2026. This rise is mainly due to the costs associated with the new HG assets and also higher wastewater tracking and disposal volumes. Interest expense, net, also climbed noticeably, up 16% to nearly $56 million. This is mainly because of the new debt they took on for the HG acquisition, specifically the 2033 and 2034 notes. Despite the higher expenses and interest costs, their net income and comprehensive income for the quarter actually dipped slightly from $124 million in 2025 to $113 million in 2026. This is mostly due to those increased operating costs and interest expenses. This translates to a net income per common share basic of 24 cents in 2026, down from 26 cents in 2025. Looking at the first 6 months of the year, total revenues increased from about $597 million in 2025 to $641 million in 2026. Again, this growth is fueled by the HG acquisition contributing to their gathering and water handling businesses. However, total operating expenses also saw a substantial increase, going from $233 million in 2025 to $271 million in 2026. This is largely driven by higher direct operating costs and depreciation, reflecting the added assets from the HG deal. Interest expense, net for the 6-month period, also rose significantly from $96 million to $110 million, again due to new debt. As a result, net income and comprehensive income for the first 6 months fell from $245 million in 2025 to $232 million in 2026. This means net income per common share basic was 49 cents in the first half of 2026, down from 51 cents in the same period of 2025. The HG acquisition is definitely the headline event here. While it is boosting their asset base and revenue potential, it also comes with significant upfront costs and increased debt, which is impacting their profitability in the short term. The Utica Shale divestiture, on the other hand, is streamlining their operations by selling off less strategic assets, freeing up capital, and reducing some operating expenses. When we look at their cash flow statement for the first 6 months of 2026, we see a dramatic shift in investing activities. Net cash used in investing activities soared to over $815 million compared to just $72 million in 2025. This massive increase is almost entirely due to the $1.1 billion cash payment for the HG acquisition. Financing activities also saw a big change. After using around $392 million in 2025, they generated about $60 million in cash from financing activities in the first half of 2026. This is thanks to substantial borrowings under their credit facility, which they used to help fund the acquisition and refinance other debt. The refinancing efforts are further highlighted by the call for redemption of the 2028 notes, which happened right after the reporting period. This suggests they are actively managing their debt to get better terms or perhaps reduce overall interest costs. A significant legal item mentioned is the ongoing lawsuit with Veolia Water Technologies Incorporated. This case has been going on for years, and it seems like a major development occurred in July 2026, when Antero Midstream received a large payment of approximately $371 million related to a court ruling. This will be recorded as a gain in their upcoming financial reports. It's a reminder that legal battles can have a substantial financial impact, both positive and negative. Regarding risks, the company continues to emphasize commodity price volatility and its impact on Antero Resources, their main customer. However, they believe their fixed fee contracts largely insulate them. They also highlight operational risks, government regulations, and potential supply chain disruptions, which are pretty standard for the industry. Looking at their strategy, the core focus is on growing their midstream assets in the Appalachian Basin, particularly by servicing Antero Resources. The HG acquisition fits right into this strategy, expanding their footprint in the Marcellus Shale. Their plan to renegotiate commercial arrangements post-acquisition, especially for well pad compression and water services, shows they are actively integrating the new assets. The company also continues its share repurchase program. They bought back about 0.4 million shares for $8 million in the second quarter of 2026, and a total of 1 million shares for $26 million in the first half. They still have about $310 million of capacity left, which shows they are returning capital to shareholders, while also investing in growth. So, what is the overall picture here? Antero Midstream is clearly in a phase of strategic expansion. The HG acquisition is a bold move to grow their asset base and customer relationships, which is reflected in their increased assets and debt. While this has put some pressure on short-term profitability and cash flow due to higher expenses and interest costs, the divestiture of the Utica assets and the refinancing of debt signal a focus on optimizing their financial structure. The large legal settlement provides a significant financial boost that will be recognized soon. What I am watching closely is how well they can integrate the new assets and if those customer relationships translate into sustained revenue growth. Also, their ability to manage their debt levels while continuing to invest will be crucial. For now, they appear to be navigating a complex period of growth and financial restructuring. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, give it a like and subscribe for more, and join our community on Discord. The link is in the description.